Through the first 3 months of 2023, uncertainty has emerged as the primary theme in finance. Bank failures and runaway inflation are driving monetary policy. With the end of Q1 upon us, are the markets finally ready to pick a direction? Perhaps late March trade will provide us some much-needed answers. Welcome to Trading Week number 13 of 2023. I'm Shane Vernier, market analyst at howtotrade.com. Compared to the last week's economic calendar, the coming 5 days are expected to be relatively quiet. Of course, volatility knows no schedule, and we still have a collection of events that can sway the markets across the asset classes. So let's break down the key underpinnings of week 13. Over the past 18 months, inflation has negatively impacted all of our lives. Inflation is the hidden tax. It's one that no one can truly avoid. But are rising consumer prices beginning to taper? This week, we'll look at the latest German CPI, EU CPI, and US PCE readings in an attempt to gauge pricing stability. The Wall Street consensus expects each of these numbers to come down from the previous levels. If they don't, brace for heavy volatility across the FX majors. Now, aside from inflation, the world of finance continues to be abuzz over the recent banking meltdowns at Silicon Valley Bank, Signature Bank, and Credit Suisse. Many in the financial media believe the crisis to be over. In fact, last Wednesday's FOMC presser, Fed Chairman Jay Powell stated that SVB was an isolated incident where management failed badly. So is the U.S. banking crisis of 2023 over? That's truly an unknown unknown and a situation that traders around the world are monitoring closely. With inflation and banking pressures on the front burner, the markets have been in flux for the past 2 weeks. Let's break down the evolving market dynamic with our expert analyst in the UK, Nick Quinn.
Monday starts with quite a light economic calendar, which will be a bit of a relief considering all of the banking crisis fallout that has been dominating markets for what feels like such a long time. I'm very interested in the German IFO business climate data on Monday. I think it's going to be really super important for Germany because we're moving towards the end of the month and we're also moving to the end of the quarter as well. There's a high risk that Germany might be the first leading economy that's going to potentially fall into recession. That puts a lot of emphasis on the DAX as a result, and I just want you to note the falling off of momentum. Look at the MACD here. It's just really starting to diverge from the sequence of higher highs that we've had. This is the area that I want to focus on. Depending on how we end the week and depending on where we actually open the European session on Monday, this area here, 15,500 all the way down to 14,900. That is the key area that I want to focus on, and it's this bit here from January in 2022. So whilst we're in there, we're potentially looking for rotational plays. However, we are looking for a softening in data out of Germany, and if there's a risk of a potential recession, I would look for this market to trade to the downside and do it relatively quickly. The China reopening story does not look like it's happening anytime soon, and a lot of traders are using the Australian dollar as a proxy for trying to understand exactly what is or isn't happening in China. There's a lot of focus on the Australian dollar on Tuesday, particularly because the retail sales are expected to underwhelm. You can see on this daily chart here, I've just posted in where all those key interest rate decisions from the RBA were actually placed in terms of price action over the last year. And currently as it stands, as we move in towards the end of this week and we open up into next week, it's starting to look like we've got a bear flag actually forming on the daily, which would be obviously a continuation pattern, and we'd be looking for the Australian dollar to trade to the downside. Key area for me would be this area of support, potentially if we have a break lower and then a move into that support area. It's this here all the way from October 27th 2022. That comes in at around about 65, the early 65s, all the way down to 64.22. So that area is absolutely key for me in terms of looking for either a bounce point or potentially then trying to gauge where they're going to get a longer term play to the downside. Stocks and bonds are not the only markets to have suffered in the banking crisis that we've seen. Take a look at this chart of crude oil. The commodity complex has been in full-on risk-off mode. Now, this is a harmonic chart pattern that I've got on this daily chart time frame here that you can see in front of you. This is a bullish butterfly setup, and this price reversal zone here that you can see at around about the sort of the late $66 a barrel has seems to be at the moment seems to be holding. So I'm very interested to see if we can actually get any traction. Maybe the wise bets would be for continuation to the downside. However, the harmonics are a very valid way to look at the market, and all we basically need is some kind of dialogue from OPEC Plus to now come in and step in and curtail the supplies to potentially contain the crude oil market, and we will get a meaningful reversal to the upside that would tune in very nicely with trading this harmonic. Now, stop loss areas would obviously be under our recent lows, but potentially profit taking could be around the 38.2 and the 61.8 of this X to A swing. Those are the key areas that I would be focusing on. Unemployment data in Japan has been trending down, and the market is expecting the data on Thursday to be in line at 2.4%. That is not a dovish story, particularly if we actually get a further decrease in unemployment data. The reason it's not is because we're going to get a new change of governor in the Bank of Japan relatively soon, and there's a lot of eyes on him to see exactly how dovish or hawkish he is going to be. Now, I'm very bearish on the Australian dollar, and as a result, I'm pretty bullish on the Japanese yen. So I think the Australian dollar against the Japanese yen cross-currency pair is a particularly interesting market to be having a look at if we get some meaningful traction out of the unemployment data. You can see we've already just towards the end of this week just pushed below the 87.30 swing low from December in 2022, and what that would do, any meaningful move from here, I suspect that the floodgates will open and we could move quite swiftly to the downside as a result of that. This is the key area here that I would want to focus on. That's this area here from the support point from February 2022, coming in at around about 83.97, something like that, all the way down to 82.05. We're going to finish Friday with a big dose of the most important inflation data that we get out of the US, and that is the PCE inflation data. It's important because that is the measurement of inflation that the Federal Reserve favors. Now, it's particularly difficult at the moment. Headline inflation has been rolling over, but the PCE data is still not budging, and that is the potential problem that we've got. The stock market has to factor in. Now, you can see this symmetrical triangle that we look like we're starting to form on the daily, and that makes the actual landscape for stocks particularly difficult at the moment. It has been very noisy with the banking crisis that we've seen, and as you can see from this chart, it's been particularly difficult to get the direction right. And by the time we get to the middle of the year, you can look back and really start to think, gosh, we haven't really moved that far. And if you look at this green line here, this is signposting for you the yearly close from 2022, and as it currently stands, we've not really moved very far from that point at all. So despite everything that's happened this year so far, there's not been a great deal of direction in the stocks. Now, if we do get a meaningful downtick in inflation data on Friday from the PCE data, then I suspect it's really the last chance to see whether our hawkish dovish play has really got any validity left in it. It should play out to the upside if we get a downtick in inflation data, and if that doesn't, if it remains sticky, we should be looking to get back down towards that 2022 yearly close, and then hopefully from there, as we enter quarter two, we actually get a meaningful move in stocks and a decent trend to the downside.
Thanks, Nick. So how will the greenback close Q1 2023? That's the trillion-dollar question, and one that investors are going to answer beginning with Monday's opening bell. Right now, there's a growing belief that the USD is going to fade as the year progresses. In fact, derivatives traders are pricing a 95% chance of the Fed cutting interest rates ahead of Christmas. If they're right, then we may have seen the worst of the equities market angst and a top in the USD. If they're wrong, then the dollar will be back in vogue and risk out of style. Only time will tell, so stay tuned. If you're struggling in the markets this year, check out our trading room at howtotrade.com. Featuring daily live streams, trading tools, and a comprehensive video library, we are confident that the HTT Trading Room has everything you need to get on the right track. In fact, we just uploaded 6 brand new training modules full of educational content. When you're ready, drop in and check out the How to Trade Academy. We're confident that it will make you a better trader. Until next time, trade the action well, and we'll see you on our next live stream.